January. Goods price inflation was 3.0%, while services price inflation remained at 5.2%. The bank's measure of core inflation, which excludes food, fuel, and electricity, was unchanged in February at 4.4% for the fourth consecutive month. Producer price inflation for final manufactured goods increased to 4.7% in February from 4.1% in January. The inflation forecast generated by the SAPS quarterly projection model is broadly unchanged since the previous MPC. Headline inflation is expected to average 4.8% in 2019 before increasing to 5.3% in 2020 and moderating to 4.7% in 2021. Headline CPI inflation is expected to peak at 5.7% in the first quarter of 2020 and settle at 4.5% by the end of the forecast period. Previous MPC statements have highlighted the risks to the forecast presented by volatile oil prices and food price surprises. In light of recent developments, the assumptions for Brent crude oil in the QPM were revised up by $2 per barrel from $62 to $64 for 2019. The assumptions for 2020 and 2021 are unchanged at $65 per barrel. Fuel and levies announced in the 2019 budget have been included in the forecast. The turning point for food price inflation has also been difficult to predict due to lower than expected meat prices and weak demand. Food price inflation is expected to bottom out in the first quarter of 2019 and to peak at 5.9% in the second quarter of 2020. The forecast also takes into account the recent electricity tariff increases announced by the National Energy Regulator of South Africa. The assumption for electricity price inflation, which takes into account municipal price adjustments, has increased from 12% to 13% for 2019/20 and from 6% to 9% in 2020/21. Higher food, fuel, and electricity prices are expected to lift inflation over the medium term. However, this is expected to be offset by lower core inflation as unit labor costs and inflation expectations moderate. The forecast for core inflation is lower at 4.8 in 2019, 4.9 in 2020, and 4.5% in 2021. Average inflation expectations have been declining since the end of 2017. Inflation expectations, as reflected in the survey conducted by the Bureau for Economic Research in the first quarter of 2019, declined from 5.4% to 4.8% for 2019 and from 5.4% to 5.2% for 2020. Average five-year expectations also came down from 5.3% to 5.1%, which is the lowest level since they were first surveyed in 2011. The inflation expectations of market analysts in the March 2019 Reuters Econometer survey are also lower at 4.7% for 2019 and remained unchanged at 5.3% and 5.2% for 2020 and 2021 respectively. Expectations implicit in the break-even inflation rate remain sensitive to exchange rate movements. While still higher than the midpoint of the inflation target range at 4.97%, the five-year break-even rates are at their lowest level in 4 years. Although global growth conditions remain benign, the pace of growth is slower than previously anticipated. Business confidence has softened amidst increasing concerns about weaker trade and production, ongoing trade tensions and tariff hikes, as well as country-specific factors. Global GDP is expected to pick up over the medium term, but risks remain tilted to the downside. A further escalation of trade tensions, rising geopolitical risks, including the possibility of a no-deal Brexit, and renewed tightening of financial conditions could further weaken growth in an environment with limited policy space. A slower pace of monetary policy normalization is expected in advanced economies. Most of these economies are growing at levels close to or above their potential, while inflation remains below targeted levels. Inflation expectations are contained and in some instances lower than targeted inflation. Recent communication by the US Fed and the European Central Bank has signaled that their monetary policy stance will remain largely accommodative for now. Emerging market currencies have generally benefited from indications of continued accommodative monetary policy in advanced economies and low market volatility. Currencies of countries with stronger macroeconomic fundamentals are better placed to benefit from these developments. The rand has been affected by idiosyncratic factors such as domestic growth prospects, political developments, and policy settings. Since the January MPC, the rand has depreciated by 6.4% against the US dollar, by 5.2% against the euro, and by 6.1% on a trade-weighted basis. The implied starting point for the rand is 14 rands against the US dollar, compared with 14 rands 30 at the time of the previous meeting. At these levels, the QPM assesses the rand to be less undervalued. GDP increased by 1.4% in the fourth quarter of 2018, averaging 0.8% for the year. Fixed capital formation remains weak. This is largely due to declining investment by public corporations and government, as well as weaker business confidence, as suggested by the most recent RMB BER Business Confidence Index. The Absa Purchasing Managers Index moderated from 4.9 index points in January to 46.2 index points in February, driven by a sharp decrease in business activity and new sales orders. The SAP's composite leading business cycle indicator has trended lower since February 2018 and contracted further by 1.8% in January. Household consumption expenditure has been stronger than forecast, but remains constrained by low employment growth, electricity price hikes, and higher petrol prices. Over the forecast period, growth in household expenditure is expected to decline to 1% in 2019 and 1.4% in 2020 before increasing to 1.8% in 2021. The SAP now expects GDP growth for 2019 to average 1.3%. The forecast for 2020 is 1.8%, rising to 2% for 2021. This results from the bigger than expected slowdown in the global economy, declines in business confidence index, potential supply side disruptions from load shedding, and growing pressure on household disposable income. The MPC assesses the risks to the growth forecast to continue to be on the downside. Electricity supply constraints and weak business confidence will likely limit near-term production and investment prospects. The committee remains of the view that current challenges facing the economy are primarily structural in nature. Given current economic vulnerabilities, prudent macroeconomic policies combined with structural reforms that raise potential growth and lower the cost structure of the economy have become even more urgent. The MPC takes note of the recent inflation outcomes and welcomes the moderation in inflation expectations. The overall risks to the inflation outlook are assessed to be more or less evenly balanced. Key upside risks are rising administered prices, including electricity and water tariffs, rising domestic food prices in the outer years, and higher international oil prices. Downside risks include lower global inflation and an extended period of monetary accommodation in advanced economies. Against this backdrop, the MPC unanimously decided to keep the repurchase rate unchanged at 6.75% per annum. The committee continues to assess the stance of monetary policy to be accommodative. Monetary policy actions will continue to focus on anchoring inflation expectations closer to the midpoint of the inflation target in the interest of balanced and sustainable growth. The MPC is of the view that there is little evidence of demand-side pressures in the economy. Over the medium term, cost push factors could arise from higher electricity, fuel, and food prices. The approach of the MPC is to focus on the possible second-round effects of the supply-side shocks. Any future policy adjustments will continue to be data-dependent. The implied path of policy rates generated by the quarterly projection model is for one hike of 25 basis points, reaching 7% by the end of 2019. The endogenous interest rate path is built into the growth and inflation forecast. As emphasized previously, the implied path remains a broad policy guide which could change in either direction from meeting to meeting in response to new developments and changing risks. That concludes our statement, and it's time for us to take questions. And as usual, if you could identify yourself and the media house that you represent, and the panel here will then deal with your questions. Yes, sir.
Good day, Governor, and good day to everyone on the team. Mfuneko from Reuters. Two questions, Governor. First question is, how significant is it that inflation expectations are starting to moderate? Do you see that as something that is temporary, or is it the beginning of a structural shift? And then a second question is, from the recent slide in the Turkish lira, do you foresee any sort of contagion impact or risk there? Thanks.
Thank you. Yes, ma'am.
Thank you, Governor. This is a forward-looking monetary policy question. You've taken a strong...
Your name,
Oh,
please.
sorry. It's Mariam Issa from Finweek.
Finweek.
Thank you. Yeah, I have a forward-looking question. Governor, you've come out very strongly in defense of the current shareholding structure of the bank, and yet the President has recently said that nationalization must go ahead as in line with the wishes of the ANC. Are you at all concerned that this might undermine the independence of the bank, lead to a change in its mandate, or erode its credibility in financial markets? And secondly, under the circumstances, if you are asked, would you want to stay on as governor when your term ends this year? Thank you.
Yes, ma'am.
Governor, it's Pranesha Naidu from Bloomberg. I've got a couple of questions for you. Firstly, the appointment of a new deputy governor. Can you give us a timeline as to when that is expected? Also, how were your interactions with Moody's this week? And can you talk about the potential impact of a downgrade, either the outlook or the rating, on the current account as well as the banking system, please? Thank you.
Yes, ma'am.
Amogelang Bata from Bloomberg News. Governor, I see that the growth forecasts for over the forecast period have been downgraded quite substantially, or they've been downgraded at least. You state that this is partly due to a number of factors, but is load shedding a significant factor among those factors? How much have the recent power cuts and possibly future power cuts, how much do you envision that will strain growth?
Okay. Mfuneko, you would recall that at the time that we were introducing the quarterly projection model in publicly in November of 2017, we had indicated at the time that we would prefer that inflation expectations be anchored closer to the midpoint of the inflation target range. At the time when we mentioned this, the inflation expectations were bubbling at the upper end of the inflation target range. And it's actually been sticky over a period of time. Now, there are a number of things that could bring inflation expectations down. Theoretically, you would expect that price setters are rational and forward-looking in their price settings. But we also know that economic agents could actually be adaptive. What does that mean? It basically says that economic agents take yesterday's or today's inflation as the inflation they would see in the future, which means that inflation outcomes are as important for inflation expectations as what forecasts are actually spelling out to be, provided that the price setters are adaptive. In an environment where price setters are looking forward and are looking ahead of what is likely to happen in the future, and they are thus rational, it becomes easier for monetary policy effectiveness because everybody would be looking at the future. And as Miriam said earlier on, she was asking, she said she's a forward-looking monetary policy question. Well, we can't have a backward-looking monetary policy question. Monetary policy, by its nature, is actually forward-looking. And so as we say in the statement, the recent decline in inflation expectations is a welcome development. And we would actually prefer to see the expectations declining further and getting anchored closer to the inflation target midpoint of 4.5%. As they are now, where they are at 5.1, 5.3, they are not yet at closer to the 4.5%. But the development is a welcome one. Is it a structural development? too early to tell if this is a structural development. If it is indeed true and it is sustained that you will see a downward trend in inflation expectations, that will actually in itself have a future impact on the inflation outcomes. And remember, lower inflation is good for South Africans, and lower inflation is a key component of what long-term borrowing costs are, whether it is for the government, whether it is for the businesses, or whether it is for the individuals. So that is a welcome development. Turkish lira developments, I'm sure if you asked the governor of Turkey what he thinks about developments in the rand, he will say go speak to the South African governor. But the previous episode of Turkish lira weaknesses did have an impact across other emerging market currencies. Similar developments seems to have taken place this time around, but not to the same extent as the previous one. The rand did react, but not as strongly as we saw in the previous episode of lira weakness. Why is it so? Our own reading is that market players are starting to distinguish between various countries and what the fundamentals of those countries are. And you are unlikely to see a general response in the manner that you had seen in the past episode of lira weakness. Prinesha, we had no interaction with Moody's this week. We had an interaction with Moody's the last time when they visited here. And like you, we are waiting to hear what they have to say tomorrow when they come out with a decision. What would the impact be on the, did you say the current account and the banking system? Well, much of the impact of any downgrade depends on how much the markets have already priced in. So to the extent that the market has priced in a possible downgrade, then if a downgrade takes place, it shouldn't have an impact on the financial markets. But you had asked on the current account deficit. So I guess then everything has been priced in, nothing happens to the variables. However, if it has not been priced in and the downgrade takes place, it will come as a surprise to the market. That could spare selling off of South African assets. Bear in mind that should the downgrade take place, South Africa will be kicked out of the World Government Bond Index. And if that happens, it's expected that the holders of South African government bonds will then be forced to sell as they rebalance their portfolio because South Africa is no longer part of the government bond index. And if that happens, it is then likely to lead to an increase in borrowing costs. And I'm now talking of a scenario where this thing has not been discounted into the market. It would lead to a rise in borrowing costs in South Africa, one. And secondly, it could lead to a depreciation of the currency as the foreigners exit our bond market. And if that was to then happen, this is an interesting one, the depreciation of the currency. If the central bank manages to contain inflation from the depreciation of the currency, could actually be beneficial for the current account deficit. And it might actually be beneficial for exports. But that is provided inflation, second round effects from the depreciation of the currency are contained by the central bank. What's the impact? What would the impact be of on the banking system? One of the financial stability reviews last year, or maybe the year before, 2016, did a stress test of the South African banking system to try and assess whether the South African banking system could withstand a possible downgrade. We modeled 3 scenarios. The other 2 scenarios are nice, so you don't have to worry about them. Let's talk about the ugly scenario, which is the most adverse of the scenario. Under the most adverse of the scenarios, it's expected that such a downgrade could lead to a protracted decline in GDP and lead to a situation where you have got an L-shaped kind of decline, which means that the GDP declines and stays at the bottom for a long time before it starts to recover, that the currency would depreciate, and because the currency has depreciated, you have a rise in inflation, second round effects kick in, so you have got a combination of recessionary conditions and rising inflation, and add to that rising borrowing costs for both the government and for South Africans, which also feed themselves through into growth. Even in that adverse scenario, the South African banking sector came out with flying colors and was able to withstand such a scenario. So we are not worried about the impact on the South African banking sector as a result of that downgrade. Amkhela. Growth downgrade, how much of this thing has to do with load shedding? When did this thing start? Not quite sure. I'm not sure whether we are having it or are not having it today. Not sure whether we will have it tomorrow or will not have it. And therein lies the problem. It then becomes difficult to model what the impact of load shedding would be on growth. All that we know is that it will be negative for growth. By how much, we do not know. However, the forecast that we have in here has taken account of the impact of load shedding on business confidence and the loss, and that feeds itself through into inflation. So to some extent, the impact of the load shedding is in our forecast, to some extent. But there are so many unknown variables because this load shedding, it depends on who has been load shed. If the households are load shed, you know, they could go on. But if factories are load shed, that basically means people from the households can't work, which basically means disposable incomes go down. That could be disruptive. So you need to get a handle of exactly who is load shed, for how long, and also importantly, what the availability factors are for Eskom during that period. And it also depends on whether the load shedding is just for a few months and then we would be okay, whether it's for 6 months or whether it's for the whole year. All of those parts are moving at the same time, and it is difficult for us to pin down and say this is a number. I am aware that there are a number of estimates out there in the private sector. How they arrived at them, I do not know, but besides good modeling, there is another forecast that works. Miriam, the MPC didn't discuss the shareholding structure of the bank, and we didn't discuss nationalization and independence, and the MPC didn't discuss whether the governor would stay or not. So at the end of the, once we have dealt with all the important forward-looking monetary policy issues, we might just come back to your question. Are there any forward-looking monetary policy questions? Yes, sir.
Hello, Governor. It's Lucanio Mnyanda from Business Day. Governor, I just wanted to follow up on the question about the credit rating agencies. You gave two scenarios there, but looking at the markets where they are now, to what extent do you assess a downgrade to be in the price already? Do you have a view one way or the other? And also, Dr. Nimi, you mentioned the issue with currencies, emerging market currencies. I just noticed it's maybe different in tone because you're no longer talking about future instability as a risk. Do you, in terms of emerging market currencies as a whole, do you think that's out of the way now for the rand? Do you not need to worry about the outlook for emerging markets overall as impacting potentially on the rand and the inflation outlook?
Yes, sir. No, go.
Thanks, Governor. Just a follow-up to my previous question. So, if inflation expectations were to be anchored around the midpoint for a sustained period, would that then be enough for the bank to broaden the scope of its mandate to explicitly include other factors beyond just inflation targeting?
Any other? Nada. Somebody on the cast.
Yes, Governor, I have questions from analysts. Gift Dlamini from Instinctive Partners. Governor, are you comfortable that the stance you took in November was not too early, given a sudden change in inflationary risks cited at the time? Dutch Bank, Danelli Masia. Can the MPC please share its latest forecast for unit labor costs in light of the revisions to core inflation and recent data pointing to even lower trends? A last one, Governor, from Andrea Messiah, Morgan Stanley. The electricity price assumptions adopted at the meetings are higher than those announced by NERSA. Can you explain why you have chosen to adopt high increases such as these?
Right. You want to deal with electricity. Fundi, will you deal with unit labor costs? Or you are ready for unit labor costs? You want to deal with Lekanyo's question? Great. So shall we start with Lekanyo's question then, since you are readier than the others?
Right. No, Lekanyo, it's difficult to have a view in terms of what might be or might not be priced in it. I think what is, of course, fact is that it cannot be all priced in at this stage because some of the investors that are rating sensitive in terms of needing to perfectly track the index are constrained, for instance, from front-running any potential view that they may have on ratings action or not. So they can actually only adjust their positions once it has happened. So one's got to assume that there's an element of that certainly will only move once a particular action has been taken and they are finding themselves constrained in terms of the investment mandates that they work along. But there are different views, as the Governor indicated earlier, in terms of those that may have anticipated or have a view that this downgrade might be coming, depending again on when they think that might happen. They will have sort of put their strategies in place in different ways. So we haven't got a views this way or that way. What I think is important to state there is that clearly what we would be concerned about would be the impact and the magnitude of, say, any movements that would happen in the exchange rate. But again there, we will stick to our policies as we've previously stated them. We will not stand in the way of what may then be a repricing and adjustment that would happen in line with that. But as we said, if it were to happen in such a manner that the orderly function of our markets could come under threat in any way, we would obviously want to make sure that we restore such orderly functioning. But at this stage, that is not our base case, that we would get to that position, that our markets would be under that much pressure. The second question about whether the EM story is behind us in terms of wobbles, if I understood it correctly, and vulnerabilities. I'm not quite sure one can say that, given that we find ourselves in an environment that continues to be characterized by high levels of uncertainty, of volatility. So the big issue, as we state in our statement here, is that markets, in particular, since the last meeting, have become increasingly concerned about the global slowdown, that it seems to be proceeding at a pace that was previously not anticipated. The jury is still out on things like trade tensions and how much they are already registering, or there might still be further pressures down the line. Brexit is unfolding by the minute, and the implications of what that might be, we don't know. So all of that, and again, the issues around timing and understanding exactly what the forward guidance in terms of policy, monetary policy that came from the key central banks, how that would express itself in terms of actual policy actions down the line. All of those issues are uncertain and will affect markets going forward as markets try to price these various developments. In the process, emerging market currencies will be affected. So one could not, with any high level of conviction, say that issues around emerging market currency volatilities might be behind us.
Okay, I'll come back to you to deal with Dlamini's question on the November decision. Just remind him that we are in the March MPC, not the November MPC.
Thank you, Chair. Andrea Macia's question on the electricity price assumption. There are three components of the electricity price assumption. The first is the NERSA tariff increase, which is around 9% in the first year. But NERSA have also allowed Eskom to recover an amount called the Regulatory Clearing Account, the RCA. That adds about 3.8, 3.9% on top of the electricity price increase. So that takes it from 9 to about 13.8, 13.9. The third component is the municipal margin. So let's assume that municipalities take 20 to 30% of their electricity tariff for their own maintenance reasons or the grid maintenance. That portion is going up by less than 13.9%, bringing the overall increase down to 13, thereabout. So our assumption was 12%, it goes up to 13, and those are the three factors at play in the increase.
Fundi?
Thank you. So on compensation of employees, that's been the main driver of declining unit labor costs. So Statistics South Africa has recently made some revisions to their data on compensation of employees. And we have indeed seen compensation of employees declining since around 2016, especially in the private sector. So what we've incorporated into our forecast is this declining trend, but whether this will be sustained, I think is very difficult to tell right now. So all we have is the data for the next 3 years, for the past 3 years, and then we have just projected that slow decline in compensation of employees is likely to be sustained over the next 3 years. However, we remain guided by any changes that we might see in the data.
Just to say that, yes, there was a revision, but Stats SA will be doing its benchmarking sometime next year, or they would announce the results next year. Compensation of employees is a very important aspect of the national accounts, and it's difficult to focus in the current environment because we do not know exactly what the final revisions would look like next year in March. Mr. Minele.
With regard to the question pertaining to the November decision of the MPC, yes, quite a number of people have asked whether with hindsight we might think that might have been premature or have gone as far as saying things like policy mistakes. We don't think so. We believe that that was the correct decision at the time based on our assessment when we got together in November, that again on the back of what we knew then. Remember the time leading up to that meeting, if you go back actually a little bit further, essentially taking the evolution of the development since the beginning of the year, if you wish. So basically, second quarter, I would say around about, April, May, we had seen a turnaround. Emerging markets had been under quite a bit of pressure. The issue around normalization of monetary policy and tighter financial conditions had been going on leading up to the November meeting. We had seen the exchange rate developments weaken. The oil price going into that meeting, you'll recall, had been on a very sustained and almost vicious upward path. None of us could know at the time we met that literally a week or 10 days afterwards things would turn. None of us could have known that there would be a change in tone and assessment from the major central banks, towards the very end of last year and early this year. So our assessment at the time of what the risk profile entailed in terms of what that could have imparted on inflation developments resulted us in taking that decision, and even with hindsight now, we think that was the correct decision.
Good. I guess in partly to follow up on Daniel and in response to Lukhanyo. So Lukhanyo, let's assume that on Tuesday morning when we started the MPC, we thought that the Fed is not going to hike and therefore rand risk is off the table, and then Wednesday Turkey happens, right? The point I'm making is that yes, tighter global financial conditions is a factor that we've got to take into account, but weaker growth also has potential negative effects on the rand and on emerging market currencies, especially through the commodity price and the trade channel. So it's in one way translating one set of risks to another. It's not that the risk is gone.
Okay, thank you very much. Let's deal with the non-monetary policy things, and then that is the end of the... do you still have somebody there, Zian?
Yes, I do, Governor.
Somebody?
Yes.
Who is it?
It's two people. It's it's Peter Montalto with 3 questions. Governor, can you explain why there is such a focus on expectations being at the center of the target? Why are you being so focused on that point and not the range? The second linked to this, there is a constant question about cuts in the market. Would you cut rates if expectations reach the center of target, or is existing monetary policy already primed for this? Finally, why have you revised up the neutral real rate in the model? That's Peter. And Felipe Yamada, Capitalo. Governor, the MPC nominal and real effective change rate forecasts were revised backwards for 2015 through to 2018. Did the basket change? What factors warranted this revision?
Okay, the last one is the easier one. We only forecast, we do not revise backwards. Whatever has been revised backwards, it is Statistics South Africa, not us. So that deals with that. Peter, I hope you're listening. Why focus on the midpoint and not on the range? The midpoint is on the middle of the range, so it is part of the range. We had communicated this before, that our QPM does not work on a range, it works on a point. And it is actually interesting, maybe I should remind Peter that in the many interactions that he had, he asked, why don't you have a point target? Why do you have a range? And now we have given him a point. He is asking, why are you having a point and not a range? So it looks like you would never win with him. Well, if expectations get to the target, would you be cutting rates? Well, we don't know. We will cross that bridge when we get to it. But if expectations get to the target of 4.5, that is where we want them to be. So we will assess on at that stage what the outlook for inflation is, and on the basis of that, we will make an appropriate decision. Neutral rate, why has it moved? There are a couple of components to the neutral rate which have also moved during this period, including country risk premia and the lot. And bear in mind that neutral rate is not a constant a variable. It moves all the time, and that is what we have got to take cognizance of when we determine what the neutral rate is from one meeting to the next. Be that as it may, the change is 0.1, Peter. It's like a rounding off error. Back to Miriam. The shareholding of the bank is different from the independence of the bank and is different from the mandate of the bank. The three are different concepts. There is a central bank in Europe which has got private shareholders. It is not particularly independent. There is a central bank in Europe that is fully owned by its government. It is known as the most independent central bank in the world. It's the Deutsche Bundesbank. Don't ask me about the other one. The South African Reserve Bank is a creature of the Constitution. It is not owned by the shareholders. It has got private shareholders in it. They are not owning it. If you look at that, you will realize that they actually look like preference shareholders, like ordinary shareholders, unlike ordinary shareholders. So the three are different. The independence of the bank is enshrined in the Constitution, and the mandate is enshrined in the Constitution. So the three are different. The president, conversations that the president and the governor have remain between the president and the governor. I had stated that should I be asked to serve again, I am available to serve again. But you must understand that it is the president that makes that decision. And you must give him the space to make that decision. Or rather, should I say, you should be asking him that question. But the point here is that you must apply your mind to any decision that you are making, and he must be given that space to apply his mind. Which links then to Prinesha's question about the new DG. It is an appointment of the president. He must be given the space to apply his mind so that he can appoint a DG. Which then brings me, Mfuneko had this thing that if expectations reach the midpoint, would you then consider broadening your mandate? Our mandate is captured in the Constitution. And it's stated as protecting the value of the currency in the interest of balanced and sustainable growth in the Republic. The Constitution further says that we shall do such other things as are ordinarily done by other central banks, and such other things would have to be captured in a national legislation. So the National Payment Systems Act spells out the functions of the Reserve Bank in terms of the payment system. The Banks Act spells out the responsibility of the Reserve Bank with respect to the supervision of the bank. The Financial Sector Regulations Act spells out the responsibility of the Reserve Bank with respect to prudential authority. The Currencies and Exchange Act spells out the responsibilities of the Reserve Bank with respect to financial surveillance. The Financial Sector Regulations Act has also added a further explicit mandate to the bank, which is that of financial stability. All these things that I have spelled out are the things that are ordinarily done by other central banks. So, when you say we broadening the mandate, our mandate is very broad. We've got to take cognizance of financial stability. We've got to make sure that the national payment system is working. We must make sure that financial surveillance takes place. We must make sure that the financial sector is prudentially regulated. So, the Constitution says the primary object is price stability. All these other things are things that are ordinarily done by other central banks. What that tells you is that if there is a conflict between these other things and the primary mandate of the bank must stick to its primary mandate. That concludes our... Miriam, what's this?
Sorry, Governor, just a quick follow-up. Just to clarify or to confirm what you said, does that mean then, in your mind, nationalization does not in any way threaten the independence of the Reserve Bank?
I can only answer that question when I see the bill in Parliament that spells out what nationalization of the Reserve Bank means. Okay, thank you very much, ladies and gentlemen. See you in May.